Welcome to Wall Street Sizing Up. We're glad you're here. Today's a good video. Today we're talking about GameStop. We're talking about Wall Street Bets. We're talking about Robinhood. In fact, we're talking about all the brokers and why we could not trade last Thursday. What really went down? Not that we couldn't trade. We just couldn't buy. So of course that's going to crash the price. Well, last night Elon Musk was on Clubhouse speaking with the CEO of Robinhood, Vlad, asking him point blank questions. We're going to get into those. And we're going to get into what actually happened behind the scenes that caused all these brokers to not let us purchase any of these like 10 to 12 retail stocks. So let's talk about that. Jake, hit the theme. Let's hit the casino. All right, so breaking the day. So last night, Elon Musk had on Vlad, who is the CEO of Robinhood, right? His name is Vlad Tenev. I believe that's the way you pronounce it, right? He denied any shadiness whatsoever, right? Last Thursday when you couldn't buy the stock, which made GME and a lot of the stocks essentially crash. I know it was down 50%, and I had a call option on Friday, right? And so that kind of screwed that up. So yeah, I'm intimately involved here, so I wanted to figure out what was going on. So let me go on with Vlad, and I'll give some commentary here. So when asked why Robin had paused buying, Vlad blamed his clearinghouse, the National Securities Clearing Corp. All right, so if you didn't know, I thought Robinhood cleared their own trades. They do not, right? Most of the big boys clear their own trades, but they still report up to a settlement layer. The biggest settlement company is DTCC, right? And so what he's saying is that DTCC came to the National Securities Clearing Corp, their clearinghouse, and said, hey, we need to up the collateral rate. You know, you guys usually play 1 to 3% on the buy side. Now we need 100%. Right, on the buy side because of the greater volatility and on the concentration on certain assets. So what does that do? It puts Robinhood at a very disadvantage. It puts all brokers, because all brokers had to do this. We're talking about TD, we're talking about Merrill, we're talking about Webull, we're talking about Fidelity. A lot of those big guys clear their own trades, but the thing about it was the settlement. So in settlement, there's something called T2, right? And what T2 means is that when you buy a stock, you receive the shares immediately, but the trade doesn't actually settle. There's no real handshake and money being transferred for 2 straight days. That's called T2. Blockchain will ultimately get that down to being an instantaneous transaction, but we're not there yet. We're at this T2. So what happened is DTCC is putting pressure on, say we need 100% collateral. So that meant that if you bought GME or any of the meme stocks, right, that instead of 3% that Robinhood had to put up, they had to put up 100%. So if you bought $1,000 worth of GameStop, let's say on Wednesday and now going into Thursday, they had to cover the full $1,000 for 2 straight days. And when you multiply that over millions of buy-side trades, that starts to become, I think the average trade they said was $500 in the meme stocks, right? So when you have to cover millions and millions of trades on the buy side at $500 average trade, that's a lot of money. They needed $3 billion. He said they later negotiated that down to $1.4 billion. That's why they went that night, on Thursday night, they went to their investors. They raised $1 billion and they drew down $500 million on their line of credit to cover that. So that's what was going on. Just today, now it's Monday, just today they went back to investors and got $3 billion more. Must be nice, right?
Okay, you had a balance of 93 cents.
All right.
And at an average of 2.25% interest over a period of 1,000 years, that comes to $4.3 billion.
They got $3 billion more. Musk also went on to ask about the relationship between Robinhood and the market maker Citadel Securities, because if you're not paying for the product, which you're not, there's no commission fees, you are the product. That's the saying, right? And so he said there's no chicanery there. There was no real connection. There was no pressure on us. That's just a false rumor that they put pressure on us to stop the buying of the securities, right? So if you didn't know, the reason that you have no commission trading on Robinhood and a lot of these platforms now is because they sell your data, and Robinhood happens to sell their data to Citadel Securities, and that's why the question was asked. He said there was no chicanery and no pressure, right? So that begs the question. So what actually happened? So now we know about T2, the settlement layer, the clearing of your own trades and how that has to take place, right, on the back end, right? So we kind of get that now. So this is from Slate. So they went and talked to a Redditor who is a part of Wall Street Bets, has been there for a long time. When I joined, it had about 1.5 million in that subreddit called Wall Street Bets, or WSB, right? Now they've got 6.1. I'll refresh this. I bet this is probably closer to 6 million right now. Oh, 7.9 million they have now. That's crazy numbers. That has grown literally 4 million in the past week. All right, so they go and talk to the software engineer. He's 36. That's not his real name. They call him Jason. That's not his real name, but he's been on Wall Street Bets for a long time, and he basically tells the story of how this guy named Deep Value, a guy named Keith Gill. You see him here. This is the guy. He's the one that started with the $50,000 position in GameStop, really, and really galvanized the subreddit Wall Street Bets. That's him there. His name is Keith Gill, but he goes by Deep Value, if you know what I mean. So Jason goes on to say a lot of things, and he talks about the people on Wall Street Bets, and they're really posting sophisticated stuff. These weren't just individual investors, right? These were a lot of groups. There were a lot of people getting together, but there's some sharp people on there, right? And so they started to see more and more and more. And then they often talked about one of the great crimes in finance and financial understanding, at least in this country, is that finance has its own language. And this is so true, that finance uses these complicated terms for themselves when the actual process is not that complicated. And so it makes you wonder if the reason we talk about finance and the markets in these weird terms, it's so that they keep most people in the dark. And I've thought that for a long time.
Pavina stems a parabolic and paraceltin reflector lucidity overleases the homovisory and heterovanal effect, so that neglectance of Mermat's atmospheric supercontraction causes struck dimension of faction cavity there.
That is absolutely true in finance because the concepts aren't tough, right? He said deep effing value. Keith Gill kept talking about this classic value thesis, right? How the hedge funds were treating GameStop as it was going out of business, it was going bankrupt, but yet it still had all this cash, right? And so they started a lot of people on Reddit saw what he was posting, told him to sell when he had he had 2x his gains. I think he got up to like 114,000. They were like, sell, man, the spread's too big, blah blah blah. But he kept pushing forward. Said, look, if these guys buy back their shares, if GameStop were to buy back the shares, you can really push the share price up, right? And so that shows the level of sophistication when these people are having these type of conversations. he goes on to say about 6 months later, Cyan Asset Management, that's run by Michael Burry. Now you might understand that name because that name was in The Big Short.
Did you think it was strange when the tech bubble burst in 2001 and the housing market in San Jose, the tech capital of the world, went up? That's strange.
No, it's housing. Housing is always stable, low risk.
Yeah, that's the idea. Yeah.
He came out and said, hey, he's got the same strategy. He saw the same thing that Keith Gill saw, and that was there was a lot of shorts. And so if you know anything about shorting, right, they're betting that the stock is going to go down. They have to borrow shares, right? And then when the stock goes down, they make money on the spread, right? So if it's a $10 stock, it goes down to $4, they make $6. Christian Bale saw this too, right? And so Christian Bale, sorry. Michael Burry,
I'm Batman.
who was played by Christian Bale in The Big Short, saw this too. And so it wasn't until about 2019 that this all was taking place later, mid-2019, and deep value showing his gains, blah, blah, blah. Then it all, or early 2019, he's shown his gains. It all crashed like everything else did. But then that's when it clicked with people that there was all this short interest. And the thesis is that if they start buying back their shares with all this cash, the shorts will literally have to buy back the shares at the higher price. And that's just going to add rocket fuel underneath the stock price, right? If the company does survive, which the shorts didn't think it would, that at some point the shorts were going to have to cover themselves, and that was going to send the stock way, way, way up. Well, it did to 1,600%, because at this point the stock's sub 5, right? Stock got to what, 480 plus. Now it's back down to about 200 today. When you short, here's where they talk about short stocks. When you short a stock, you borrow the shares at one price, sell them into the market, and agree to buy them back if the price goes down. You make money on the difference, but there's a catch. If the stock goes up, it's the financial equivalent of getting caught with your pants down, because you have to buy the stock back at a higher price and lose your money. And the creditors realize that if they bought enough GameStop stock, that is exactly what would happen to the short-selling hedge funds. The price would go up, the big guys would lose money, and the internet investors would win. It's called a short squeeze. And if you're a creditor, you were delighted that this could happen because you make money as well, right? And there's also this whole thing of let's stick it to the man as well. Because these guys on this subreddit on Wall Street Bets, they lived through 2008. They saw what their parents had to go through. They had to take second jobs. They lived in I don't want to say poverty, but people lost their jobs and they lived through this, right? So April of 2020, someone named Senior Hedgehog wrote a post, the biggest short squeeze of your entire life, and he talked about what deep effing value was doing. Plus, a well-known investor named Brian Cohen had taken a stake in GameStop as well. Now, we saw this too. Brian Cohen's his venture company is called RC Ventures, and we saw it as hedge funds sized up, and we saw him take positions. In fact, I think I've got it right here. Here's all the positions that he took right here. Now this is just, he had positions before this. He had bought 470,000 shares before December 17th, but he literally bought 9 million shares in December. We caught that. We put the alert out to our SMS subscribers in late December when it was finally disclosed to the public, right? There was the bank bailouts and all of that, but for the most part, the big ones just came right back and went back to business, and nobody was harmed. It's almost like they just came right back, and there was no repercussions. And so they saw this again as a way to stick it to the man. Then Robinhood shows up. It's an easy way to trade stock for kids, for the 20-year-olds, and for the 30-somethings. I even use Robinhood, or did. But it's certainly not normal. So here's what the thesis was. Certainly not normal, but there is a bottom here. What's also not normal is the hedge funds going to 140% short interest. How do you short 140% of the stock? Well, it's called naked shorts, right? So that's where Wall Street kind of effed up, and I think that's what's going to be called into scrutiny, and it should. You shouldn't be able to short 140%. You can short 100% of the stock, but not 140%. That means that naked shorts were being used.
Why am I sticky and naked? Did I miss something fun?
We can look at Wall Street Bet's angle, and we can look at the stock price and say, oh, that's crazy. That's how people can do this. I would say flip it around. How could the hedge funds go 140% short? That's the craziest in this whole thing. It started with the hedge funds taking this too far. Too many people went into the straight and the short interest data, and that bears that out, right? That's what they saw. That's what everybody was looking at, is that there's too much short interest. This is just rocket fuel, that when this stock starts to pump, this thing is going to go nuts. And that's what happened. And so here is what Robinhood should have done. They have stock flow analysis, right? They can see all of the trades. And what they should have done is they should have seen that on the Monday, last Monday, a week ago, that you have a ton of volume coming in. Maybe we need more liquidity. But no, they did not continue to look at the analytics in a good way. They kept, I don't know what they were doing, but that was their first mistake. You've got to look at the volume flow. All these stocks, I don't know why a red flag wasn't raised, right? That's the first thing. The second thing is then on Thursday, when this whole thing starts going crazy, Wednesday was a good day, kept going up. And then like Wednesday night, they're like, hey, tomorrow you're only going to be able to sell. And that's the chicanery, and that's what everybody's mad at. It's literally like stealing, because the only way the stock can go is down. And that's how I got burned. That's how probably millions of retail investors got burned. Also, it gives the hedge funds a full day to figure out what they're going to do. Now, if I was a hedge fund, what would I do? Well, Steve Cohen at 0.72 has been caught in insider trading before, right? What did he do? Well, he paid $1.8 billion in fines. So if I'm the hedge funds and I have unlimited risk, right? If this thing goes to, $1,000, $10,000 a share, I am literally out of business. Somebody's got to cover me, and it's going to be DTCC, right? Or at the settlement layer, and there's going to be lawsuits and all of this stuff. So they kept halting the stocks on Monday and Tuesday and Wednesday. They would halt it multiple times, right? Because there was just so much volatility. But now they have completely closed off buying, right? So that was the first thing, right? Number two is they should have gone and got liquidity on Wednesday or Tuesday or Monday before all this went down. And then to deny that it wasn't a liquidity problem on CNBC. Come on, Vlad. We all know that was the problem, right? It wasn't your fault, so to speak. You should have seen the order flow analytics ramping up. But the problem is that you knew you had T2 settlement, and you knew probably that the collateral rate was going to be raised. You probably didn't know that it was going to go to 100%. But you knew that you had a liquidity problem, and that you needed to go raise, and you needed to find liquidity somewhere. That's why all you brokers were on the phone every 30 minutes on Thursday trying to find liquidity. You finally got it worked out on Thursday night, but that was too late. People lost a ton of money. Millions, billions of dollars were lost because you didn't have the liquidity, which you denied on CNBC, and that is completely wrong. Why didn't you just halt? Here's the big thing. Why didn't you just halt trading? Just halt everything. Just stop it until you had the liquidity. Why didn't the market just do it? Why didn't NASDAQ? Everybody's coming out. We need to regulate. Regulate. What? You need to regulate the hedge funds. Don't need to regulate retail investors who just kind of galvanize together and continue to this day. You're not going to regulate the common man. Regulate the hedge funds who are shorting. Regulate the hedge funds who are naked shorting. Regulate the transparency. They need to be more transparent, not less transparent. That's what needs to be regulated. All right. So today there are meme stocks that are up and still going up. There's a silver short squeeze. Looks like that's going on. I don't know if that's the silver short squeeze was actually started by Wall Street Bets, but certainly there's a couple threads, but it's not a big thread. And if you can short silver, so here's the thing with that. If you can short silver, say to like $1,000 per ounce, you know who the biggest short is on silver? JP Morgan. You will literally put JP Morgan out of business. Now, I don't know how that affects, well, that's not good for the entire market. Let's just say that, right? You're playing with fire there, right? I'm not saying you're wrong, and I'm not saying it's wrong to do it, because if you can do it, they got caught with their pants down too. So JP Morgan, if you're listening to this, you need to get out of that short, because if the silver price goes up that much, you could literally, there may not be enough money in the world. And finally, what will probably happen is that, guess who's going to have to bail you out again? The government, which means me, which means all of you viewers, which means all the retail investors are going to have to bail them out again through our tax dollars. Money printer's going to go burr, right? So that is what happened. I hope this helps, right? You know what Wall Street Bets is now. You know where Reddit is. You know where to find it. You know what happened with Keith Gill and Deep Effin' Value, how he rallied the troops, how he saw the biggest short squeeze. Goldman Sachs calls it the biggest short squeeze opportunity in the last 25 years. And that's saying something. So he, the retail investors, Keith Gill in particular, beat Wall Street at their own game. And if they try to regulate the retail investors, that is flat wrong. And you want to see a revolt of the highest order, you will see it. So with that said, guys, I hope that answers your questions. Please leave me a comment. I'm sorry that I went long. It's very tough to explain in a 10-minute video. But with that said, I appreciate you guys. We're sponsored by StockTrade.tips. They have one goal, and that goal is to help you profit off the insider positions of the hedge funds. You can find them at the website, www.stocktrade.tips. Yes, that's a real website, stocktrade.tips. With that said, guys, watch your six, go hard in the paint. Cheers. We'll see you next time. Thanks again. Well, good day, good evening, and whatever time it may be. We hope you enjoyed that video as much as we enjoyed making it. Please hit the like or the subscribe or leave a comment, because we love that feedback. And you know what we say. At the casino, you got to watch your six, and you go hard in the paint, guys. Cheers. We'll see you next time.